Welcome back to the channel, Financial Navigators. Today, we're diving deep into a fascinating corner of the market, stocks that are proving exceptionally difficult and expensive to short. We screen for these unique situations daily, and a recent standout on our hard-to-borrow screener is a microcap company called SOBR, ticker SOBR. Now, before we get into the details of SOBR's specific setup, it's crucial to understand the foundation. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So let's talk about SOBR. This is a microcap company that recently triggered some significant flags on our system, primarily due to the astronomical cost of borrowing its shares. Currently, the annualized cost to borrow fee for SOBR stands at an astounding 675.2%. To put that into perspective, that's not a typo, 675.2% per year for short sellers just to hold their position. The momentum here is also remarkable. We've seen a plus 328 percentage point increase in this fee over just the last 5 trading days. This rapid acceleration suggests a growing scarcity. Speaking of scarcity, there are only about 10,000 shares currently available to borrow against an estimated float of 2.3 million shares. Now, it's critical to note the current trading activity for SOBR based on the data we have. Over the last 5 days and even the last 30 days, the stock has shown a 0.0% change in price. Today's volume and the 30-day average volume are both reported as 0 shares. This means, despite the extreme cost to borrow, the stock is currently experiencing virtually no trading activity. This is a crucial piece of context we'll revisit later. Our composite squeeze score, which combines all these factors, currently places SOBR at a 57.5 out of 100, which is respectable, but again, the lack of volume is a major variable. What is cost to borrow and why it matters? So, what exactly is cost to borrow and why does it matter? Show animation, short selling concept. When you want to short a stock, you first have to borrow shares from a broker, sell them in the market, hoping to buy them back later at a low price for profit. But borrowing isn't free. Brokers charge a fee, known as the cost to borrow or CTB. This fee is paid by the short seller for as long as they hold the borrowed shares. It's typically expressed as an annualized percentage. Why would it be so high, sometimes exceeding 100% like we see with SOBR 675.2%? Simply put, it's supply and demand. If a stock is highly sought after by short sellers but there are very few shares available to borrow, the price to borrow those shares skyrockets. It becomes a bidding war among short sellers. This high fee tells us two things: either there's very high demand from short sellers who have strong conviction, or there's an extremely limited supply of shares available to lend out, or often both. Why this stock is hard to borrow right now? For SOBR specifically, the 675.2% annualized cost to borrow and the plus 328 percentage point surge in just 5 days, coupled with only 10,000 shares available to borrow against a 2.3 million share submitted float, clearly indicate it's in that extremely limited supply category. Highlight CTB numbers. This kind of borrowing fee makes it incredibly expensive for anyone to maintain a short position, effectively putting a ticking clock on short sellers. The longer they stay short, the more they bleed in fees. However, with the current zero trading volume, these fees aren't translating into immediate market pressure because no one is actively trading the stock short or long at this moment. Squeeze mechanics explained. So, how does this lead to a short squeeze? Show animation. Short squeeze. A short squeeze occurs when a heavily shorted stock rapidly increases in price, forcing short sellers to buy back shares to close their positions and cut their losses. This buying action further fuels the price increase, creating a cascading effect. When a stock becomes hard to borrow, and its CTB goes parabolic like SOBR's, it adds immense pressure on short sellers. Not only are they losing money if the stock price rises, but they are also paying exorbitant fees just to stay in the game. If the price starts to move up, even slightly, the combination of rising share price and crippling CTB fees can force a stampede of short covering, leading to rapid, often explosive, upward movement. However, it's important to remember that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have incredibly strong conviction in their bearish thesis and are willing to pay a premium to stay short. Dilution risk check. One of the biggest silent killers of a short squeeze thesis is dilution. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This typically puts downward pressure on the stock price and can easily negate any upward momentum from short covering. We've checked for recent dilutive SEC filings for SOBR, specifically S-1s, S-3s, and 424 BS in the last 90 days. We found no recent dilutive SEC filings. Additionally, we've found no recent reverse split for SOBR in our look-back window. This is a positive sign for any potential squeeze scenario, as the risk of new shares flooding the market and dampening price action from that specific mechanism appears low for now. Once again, please remember. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For SOBR, the key thing to watch for, given its current state, is a re-emergence of trading volume. With today's volume and the 30-day average both at 0 shares, the market for SOBR is effectively dormant. While the cost to borrow and scarcity metrics are extremely high without actual trading activity, there's no pressure on short sellers to cover, and no opportunity for squeeze to materialize. Show chart with flatline if, and when, volume picks up, then these hard-to-borrow indicators become immediately critical. Look for any sustained buying interest, a break above previous technical levels, and, crucially, a significant increase in daily volume. Our composite squeeze score of 57.5 reflects the underlying potential, but the current liquidity is a major factor tempering that. So, SOBR presents a unique, almost paradoxical situation, a stock with an incredibly high cost to borrow and extreme scarcity, yet virtually no trading volume. It's a textbook example of a hard-to-borrow stock from the supply side, but without market participation, the mechanics of a short squeeze remain theoretical. Keep SOBR on your watch list if you're interested in these extreme hard-to-borrow situations, but prioritize observing any shifts in its trading activity. If you found this breakdown insightful, please hit that like button, subscribe for more deep dives into hard-to-borrow stocks, and let us know in the comments what stocks you'd like us to analyze next. We'll see you in the next video.